All right. So I have my employee retention credit spreadsheet up. Again, I'm going to walk you through what the general rules are of this credit. I'm going to show you an example if your business has been shut down. And this also applies to several nonprofits, especially religious groups that, due to COVID-19, have had to close their doors and not have gatherings, which obviously impacts their financials. I'm going to walk you through, again, those rules. I'm going to show you an example of closures, and I'm going to show you an example if you're still open or you're an essential business where your revenues have just declined more than 50%. And so right here on the front end, and before I keep going, just so you know, you can actually download this spreadsheet off of my website, edinkuskovic.com/PPP. And I'll have this in there so that you can play with the numbers in the closures and the revenue decline tabs to see how it impacts you. So high level, the employee retention credit is for either businesses that have had a government mandated closure or your revenues declined by more than 50% in a quarter this year compared to a quarter in 2019. So you'll need to know what you did in sales in quarter by quarter in 2019, as well as quarter by quarter here in 2020. And the credit is available up to $5,000 per employee. And it's based on the amount of wages you pay them in that particular quarter. And of course, it depends on whether you had a government mandated closure or if your revenues decline. So if you had a government mandated closure and you keep paying people, then obviously the wages that you keep paying folks all count. Where on the flip side, with revenue declines, it is going to be specific to that quarter. Again, up to 5K per employee, which is a lot. So we'll walk through those examples and what it really looks like. The applicable period here is for wages paid after March 12th. That was basically the date that the government has announced that the coronavirus is officially a disaster, a national problem that we need to confront. And most everything in terms of stimulus programs has been based off of this March 12th date. There's some that are based off February 15th. But anyway, with this, any wages after March 12th apply. And the great thing with this is you can actually request an advance of this credit. This credit is refundable, which means the first portion of the credit covers the company's payroll tax costs. And then anything that's left over actually can come back to the business, similar to a grant. It ends up being free money to cover some of these expenses that you have, including the payroll expenses. There's different rules for companies that have averaged more than 100 employees in 2019. I'm not going to worry about that. I think I might have maybe one group that has that many. Most of my businesses are usually less than 5 employees. So that doesn't even apply for a majority of folks that are watching this. And then the super important thing to keep in mind is if you got the PPP loan, you are not eligible for the employee retention credit. Super important to keep that in mind because it's essentially double dipping. It's credits towards the same wages. And with that also, if you by chance received a credit under the Families First Coronavirus Response Act, again, very few people have talked about either the Family First Coronavirus Response Act or this employee retention credit, but they did both of those offer a lot of credits towards payroll. And again, the whole idea with not being eligible for all of them is double dipping, right? The government does not want businesses to double dip into these programs. But ultimately, they all give you benefits towards paying folks, keeping them on payroll, and so forth. So let's start off with an example where we have a business that had a government mandated closure. So if we look at it, the mandated closure date, let's think about a restaurant, for example, here. Most states had stay-at-home orders effective at some point in March. But even if it was towards the end of March, again, this bill and this tax credit is as of March 12th. So what you want to do is you want to enter your payroll dates after March 12th. So it could have been March 13th, it could have been March 18th, 19th, it could have been April 1st as your next payroll date. And then what you're going to do is you're going to list all your employees and what they've earned in gross wages in each one of those payroll periods. And what the spreadsheet is set up to do is to obviously sum up the gross wages by employee and then give you a max credit amount. So again, if you had a mandated closure at some point in March and you kept paying people, whether they still needed to come in to clean up, take out orders, or what have you, or you're just deciding to keep paying them, then you have a certain amount of total pay for them, right? And the max credit is 50% of what you pay these people after March 12th. And so you want to sum all that up, and your max credit is 50% of the gross wages that you paid. Now, how does this work in terms of the concept of refundable credits, and how can you make out with this in terms of having some support and some assistance? Well, what happens is, as the company, as the employer, you have to pay federal unemployment tax, state unemployment tax, and then Social Security and Medicare, FICA tax. And so all of this ends up being somewhere around, I think it's 8%, a little bit more, sometimes closer to 9%. But essentially, this spreadsheet, again, is set up to calculate based on your total pay during these different pay periods what these taxes are. Now, if your state unemployment rate is higher for whatever reason or lower, all you have to do is enter that in, and the dollar amounts will adjust accordingly. And then what happens is we have the total payroll taxes, and the first portion of this will get wiped out by your credit. And then after your payroll taxes are taken care of, you have essentially a refundable tax credit that you can, again, request the government send to you in terms of money. So that way you have money in the bank to either keep paying your employees or, again, for other operations needs. And so it ends up working very similarly to a grant. I know a lot of people have applied for the EIDL grant, and a lot of people have applied for a PPP. If you get the PPP, you can't use this. But if you're one of those who got kind of pushed out because you're working with a big bank or your bank doesn't work with PPP, this is a very plausible way to get some relief and get some money in your pocket. Again, this first one right here is based on the fact that your business or, again, religious organizations can use this as well to get some more funding because they're going to miss out on a lot of donations for being closed. So what it allows you to do is just get some credits towards payroll taxes and have a refundable portion. So I'm moving on to revenue declines. So if your business was not mandated to close, that means this first rule does not apply to you. So for example, me and the tax business, I am considered an essential business, and I had to keep my doors open. Obviously, I'm working virtually, but what happens is I can't just go ahead and take a tax credit based on my total wages. I have to use the revenue test, essentially, and see whether or not revenues have declined in any particular quarter by more than 50%. And so the easiest way to look at this is you want to pull your 2019 revenues, gross sales, quarter by quarter, and populate them in here. And then what you're going to do is you're going to look at your 2020 sales quarter by quarter. And so the first quarter is already done. And then we're going to put in the second quarter and see what happens. Now, over here, what these numbers are measuring is what percentage is your 2020 sales as a percent of 2019. And what we're looking for is we don't want to, but if we have our 2020 revenues become less than 50% of our 2019 revenues, that's when we're eligible for this tax credit. So in this example, in the first quarter, we see that our revenues, even though they've declined significantly, they are still 60% of what they were last year. So the first quarter in this example does not count. It's not eligible for this credit. And so we don't have to worry about it. Then in the second quarter, which started April 1st and goes through June 30th, if our revenues drop, and in this case they do drop, they end up being 33% of what they were in the second quarter of 19, this is the first quarter that we're eligible for this credit. And what that means now is that any wages that we paid in the second quarter of 2020, we can put into a spreadsheet similar to this and calculate our total gross wages and our credits. And then again, with our second quarter payroll tax filings, we will be able to get this credit. And now the rules for how long can we take this credit once this has been satisfied is we are now looking for the next quarter in which our 2020 sales are at least 80% of what they were in 2019. So in this very simple example, if our third quarter then ends up rebounding and then ends up being greater than 80% of what it was in the third quarter of last year, then we can still take the credit for that quarter, but the following quarter we cannot. So it ends with the quarter that follows the first quarter in which gross receipts are greater than 80% compared to the same period in 2019. So that's a lot. It sounds very confusing, but what you're looking for is the first quarter in which sales are less than 50% of what they were last year. And then you're looking for the following quarter that is at least 80% of what it was in 2019. And then the following quarter is when you can't use it. So again, here, if third quarter is 84, that means that we can still use it. But then the fourth quarter of 2020, we're not going to be able to use it. If this number was, let's see here, 35,950, and of course, close. So here we go. If your third quarter ends up being 78%, that means you can use the third quarter and you'll be able to end up using the fourth quarter, because again, it's the quarter after that you have to stop, and this credit runs out at the end of this year. So potentially you'll be able to use this, either all four quarters or second, third, and fourth quarter to get this credit. Now, the biggest thing to keep in mind, don't get lost in these numbers, because your max credit, again, is up to $5,000 per employee, which means up to $10,000 in gross wages per employee. So for a lot of folks, in the second and third quarters when you're going to hit that 10K max, so you're not even going to have to worry about the fourth quarter. So it's really just about monitoring in which quarter do your sales drop significantly so that you can use this credit. Again, thank you for watching this. I know not many people have talked about the employee retention credit and how it works. Hopefully, if you got pushed out of PPP and didn't get it, This is an avenue for you to get some money, for you to be able to keep paying your employees. And again, hopefully have some money come back into the business vis-a-vis the refundable credit portion. And hopefully that'll help you out. So again, if you've liked these videos, if you found the information helpful, please hit the like button, share it with your friends and colleagues, and check out the additional videos that we got coming.